Income Tax 2020, Marginal and Average Tax Rates. Come in, relax with Income Tax 2020. Marginal and Average Tax Rates. In a prior presentation, we discussed the progressive tax system, comparing and contrasting a progressive tax to a flat tax having one tax rate that would be applied as income goes up, so that people earn more would still pay more taxes, but the rate would remain the same. A progressive tax system, the tax system that we use for federal income tax, means that the actual rate will increase at different levels of income. So the rate is increasing at different levels of income. That adds a level of complexity when we're just trying to think about what the rate is. So if you were just to ask someone, what's the percentage of tax that you pay? It's a complex question given the fact that now we have these different percentage rates. So we might want to then think about, well, how much tax do I pay? How can I plan things out in the future, say project out into the future? And we have to then use different rates that would be like a summary of this progressive tax system. Those different rates that we will typically use are going to be a marginal tax rate and an effective tax rate, or in essence, an average tax rate. So to understand those concepts, we first need to understand this progressive tax system. So you'll recall the progressive tax system will basically be broken out by filing statuses. So we'll talk about filing statuses later, but the general idea would be that we'd have the single filing status, married filing, joint filing status, and then head of household. You probably want to keep these first two in mind at first. Those would make intuitive sense because we would think about a single taxpayer as one individual. When you're married filing joint, the IRS sees the two individuals in essence as one entity with regards to tax preparation and the taxation of them. So then if you think about it in that way, you can kind of predict what you would expect to be the case if you go from one person filing one tax return with one individual represented by it to two individuals filing one tax return that now has two people represented by it. So for example, the brackets for the 10% bracket down here would be up to $9,875 for single. When you level up to two people, then it's going to be up to $19,750. Now, of course, you want to be in these lower brackets down here. You'd like to be paying less tax, which means you'd like to be in these lower brackets. And so the higher limit that you would get if you had two people that might have two different incomes that would be provided is going to be higher, providing more of a benefit. Let's concentrate on the single individuals now and the rates related to them. So up to $9,875 is the 10%, and then if you go down up to the $9,875 at the 10%, then if you go to the $9,875 to $40,125, we're at the 12%. Now remember what that means. It doesn't mean that, like, if you go $1 up, if I get $9,876 that are taxable income, it doesn't mean that I level up the entire thing to 12%. I'm not being taxed now at 12%, but rather I have part of my income up to the level of $9,875 at the 10%, and part of my income being taxed at the 12%. So you can see it's kind of more of a complex calculation. We have software, once again, to calculate the calculation. That's not really a problem if we have the software to do that. But then when we ask questions to ourselves, such as, well, how much tax do I actually pay? It can be what's the rate of tax do I actually pay? It can be a confusing type of question, and it's a useful question to know because that helps you plan into the future and make decisions about things. And the complexity of the progressive tax system makes that difficult. We have to use some type of estimate. And so the estimates that we will typically be using will be the marginal tax rate and the effective tax rate, or basically the average tax rate. And those will help us to make kind of decisions based on what our needs are in the future. So let's start with the average tax rate, which is also known as the effective tax rate. So the basic calculation here would simply be an average. So we're going to be taking the total tax and we can divide that by the taxable income. Now, and that'll give us the average. It'll give us the average tax because, again, when we applied the tax, when we calculated the tax, we did so based on a series of rates here. So to get back to the average rate, then, total tax divided by the taxable income. Now, notice the denominator is not gross income, but taxable income. So it's the bottom line of basically the tax equation, the bottom line of, in essence, our income statement to get down to the taxable income after the deduction. So for example, if we take a look at our tax formula, we might have on the top line, let's say we had just W-2 income of the $75,000. If we had any deductions up top, now known as adjustments to income, or if we were taking the itemized deduction, or in this case, the standard deduction, that would bring us down to the taxable income. So notice we're using taxable income, we're not using gross income. So when you're explaining that or thinking about it, of what your actual tax rate is on your earnings, you're actually down here in the taxable income, not on the top line, which is how much you might be earning if you just had, say, one W-2, and that's the line on the W-2. And also note that this W-2, if it were a W-2, can be confusing in and of itself because there could be things that weren't included in there, such as benefits like a 401k plan, a retirement plan, or something like that. So we're gonna use these averages as best we can, but again, the tax code in and of itself is somewhat complex. So when making different decisions or thinking about what actual tax rates we are paying, we got to make sure that we understand what the calculation is that we are looking at. Here's a look at the same concept in terms of tax software or the forms. This is the form 1040. So if I had the $75,000 in line 1, then we have the standard deduction $12,400 line 12. That gives us our taxable income at the bottom of the first page of the 1040. That's going to be at the $62,500. That was our denominator. The next page then you'll see will be the calculation of the tax, typically done by the software using the progressive tax system. So then we're going to take that, we're going to take the tax basically, and we could see this in a summary. This is basically the accounting equation in summary. There's the $75,000. We took then the standard deduction $12,400. That's going to give us our tax. And then there's a penalty down here that we're not going to take into consideration. But then we're going to say that we have our trustee calculator here, and we'd say, all right, well then the tax was at the 9861 divided by the 62,600, and that's going to give us, if I move the decimal over, about 15.7%. We do that one more time. It's going to be the 9568 divided by the 62600, and that's going to give us the 15.2 if I move the decimal over, which is that number right there. So typically tax software will give you that number, and the Lacerte tax software is going to call it effective tax rate. So when someone asks you, when a client asks you, what is my effective tax rate, like the average tax rate, then it'll typically give you it. There's the 15.3, but you want to make sure that you understand what you're calculating, because remember that tax then is the tax calculation not divided by the $75,000, the income that was earned, but after the deductions, which include, in this case, the standard deduction. So we got to, just understand, what it is we're talking about. And that can be useful just in terms of discussing what the average rate is. Now, if I'm looking at a projection going forward, and I'm saying, hey, look, I'm going to earn more money later, then I can't use this average rate as much. I need to use the marginal rate. Why? Because the person is already in that upper bracket. So the average rate isn't going to help me with projections into the future. And it can actually cause me problems. It could cause me to have too little of the withholdings. So the effective or average tax rate calculation, if we had an example, if we had the $20,000 total tax and the taxable income $100,000, the average, of course, then dividing that out would be the 20%. That's just an example here. So then we have the marginal tax rate, the tax rate of the last dollar of income. So here's our progressive tax system. And if our last dollar of income landed within here, if we had that $75,000, for example, we would be paying some dollars at the 10% tax, some at the 12%, and some at the 22%. But the last dollars that we paid were at the 22%. And let's say that we imagine that next year we're going to be making $100,000. We're going to be making more money. Well, it wouldn't make sense for me then to take the average of the tax at that point in time to project out how much the withholdings will be next year. I want to know how much tax I'm going to pay next year if I make $100,000 as opposed to $75,000. Then I have to use the top tax brackets. I got to use the tax brackets up here, not the tax brackets back here, because if I just use the average rate, then I'm going to project too low on the withholdings because they're already up here. So if I'm looking at the next dollar that will be earned, the next dollar that will be earned if you're at 75 will be taxed at the 22%. So I want to make sure that I'm projecting in the future on growth levels within the proper tax bracket. So the average tax is a good kind of summary of where we stand. And then the marginal tax is what's going to be used if we think there's going to be an increase in income, and we're trying to project how much tax is going to be increased from that point in time because we're already at that tax level. So once again, the software will typically find these for you. You can see on this tax return, We had the 15% for the effective tax rate. So if someone asked you how much do I pay on average, you say, yeah, you're paying about 15% of the taxable income. That's after the deductions on it. If you wanted to consider it as a relation to the actual income line, the total income line, then you'd have to divide it by the 75. And then you'd say, well, what are we going to do next year if I make 100,000? How much tax will I have? Well, you're not going to be paying the 15%. Your last marginal rate was 22%. So we're going to have to take the added income you're going to have and have it multiplied times the 22% and possibly even higher, depending on whether or not that's going to take you into another tax bracket. Once again, to do those projections, it's really useful to use software, which will do that calculation for you. But you want to basically understand the terminology of the effective rate and the marginal rate, so that when you do those projections and they ask you, well, you said I was paying 15%, and now when I add the taxes, I'm paying more than 15% more, added on the taxes. Well, that's because any added dollars being taxed at the marginal rate, the last rate that you had, and the average of all the rates given the progressive tax system is going to be lower at in this case, the 15.3%.